filming the latest in our expert series of PWM videos here at the FT headquarters with David Roberts, Head of Global Fixed Income at Liontrust. And we will address some of the challenges involved when investing in these instruments. David Roberts, why invest in bonds at all when many have negative yields attached to them?
I would say increasingly it is difficult to find large parts of the bond market that are attractive. We do think that the high yield market is a market that many people have overlooked. They frequently call it the junk bond market and forget that often it's dominated by large companies that pay an income, a yield, well above the dividend yield that we might expect on equities. And then within the market, there are good opportunities in what we would describe as relative value opportunities to add a little bit more return for investors.
But a lot of investors will be asking, are there safe equities with good yields that can now replace bonds?
Well, I'm no expert on equities, but it does strike me that that is also quite an expensive market. Of course, one of the advantages with bonds is we generally have quite a high degree of certainty with respect to capital values, which obviously, particularly in times of trouble, is not the case for equities. So we can still manufacture, create within the liquid part, importantly, within the liquid part of the bond universe, income, yield, which certainly rivals and in many cases exceeds that which we can find on most equities.
Does the old modern portfolio theory still hold? Are there big diversification benefits in investing in bonds?
I don't think there are, certainly not to the extent that there have been historically pre-financial crisis. I think we need to understand the rationale behind zero interest rates, behind quantitative easing, which is really to try to persuade as many investors as possible to take more risk. You know, the whole theory is that if we see the stock market going up, that boosts confidence, that leads to consumption, to investment, and ultimately to growth.
And you did mention liquidity earlier on as well, David. Is that now a major problem for some bond investors?
There is a tendency for investors and for their fund managers at times to seek yield and sacrifice liquidity. And that's okay in the long term if you're prepared to ride out the difficult periods. So some of those, dare I say, slightly darker, dingier corners of the market that we've traditionally shied away from may look quite attractive for those seeking yield, but we do need to remember that they are sacrificing liquidity for that return.
But you're telling us that in order to understand the behaviour of these instruments, we really have to get in the minds of these central bankers and ascertain whether they're really caring about the economies or just the stock market.
I think that's true. I mean, we had a perfect example toward the end of 2018 when economies seemed to be performing quite strongly, and yet following a fear that interest rates would rise, stock markets globally fell 10% or so. And then we had a rush from our central banking friends to promise ever lower interest rates, even though the economy was performing quite strongly. Indeed, probably my favourite statistic is that inflation at a G7 level, if we aggregate G7 economies, is actually above its 20-year averages. And yet we're being persuaded, we're being told that there is no inflation problem and that we can quite gladly, quite happily buy ever more fixed income assets. So it strikes me that traditional mandate of economic stability, of inflation control, absolutely has been met for several years, and yet still interest rates remain abnormally low.
And are you confident that central banks can maintain their independence? Because we see the constant attacks from Donald Trump on the Fed relating to their policies.
I think it's incredibly difficult to separate capital markets in a capitalist society from politics. I think for most of last year, Mr. Trump very adroitly played the Chinese situation, particularly in terms of tariff and trade, against Mr. Powell's monetary policy. I think central bankers are in a very, very difficult situation. I think we're living in a world clearly where the ability of politicians to influence markets and market direction instantly has clearly never been greater. We need to be aware of that, and especially if we're investing for the long term, to try our best at times to look through those short-term tweets and comments.